Okay, well, welcome everybody to this morning's 2-hour webinar on succession planning for your business. If you are thinking of stepping away from your operation or would like to know how to add value for the possible sale of your business, or just want to know what your options are, this educational webinar session is for you. My name is Lynn McDonough Hughes with TIANS and the Tourism Human Resource Council, and I'm pleased to introduce this morning's session. We respectfully acknowledge that we live and work on the unceded territory of the Mi'kmaq, which is covered by the Treaties of Peace and Friendship. We are all treaty people. Debi Peveril, CPA, is the facilitator for this morning's interactive session. A chartered accountant with a sense of humor, Debi has been a working accountant since 1978 and established Peveril and Associates in 1988. She has an extensive experience helping most small business owners and managers develop financially sound planning around business succession. So on that note, I am going to pass this over to Debi, and thanks everyone.
There we go. Thanks, Lynn. So what I have planned for you today, I've got divided up into 4 sections. We are going to talk about why succession is important to begin with. And, there's a couple of there's 2 different kinds of succession. One is the planned succession, where, you're figuring out what you want to do with your business and when you want to sell it in the future. Or we also have to be concerned about what we call emergency succession, where something happens that you are not in fact able to continue to run your business. What plans do you have around that? So there's a happy topic. The second part we're going to talk about is valuing a business. Then I'm going to go through the tax implications and the process of the sale. So that is the plan. I will take questions. Lynn's kind of in charge of that because I don't see the Q&A button at the moment, but if there are questions, I'm happy to take them as they come up. So what we mean by succession planning is planning basically for the sale of your business. Although some people will not be able to sell their business, they will stop running it and there won't be somebody there to take it over. Not every business can be sold, and I'm going to talk about that a little bit. The business could be what we call transitioned to family or employees or to someone outside of the organization. So when we take a look at succession, we're always about the planning. What would happen to your business if you got hit by a meteorite tomorrow? Is there something, in place that would allow the business to retain its value for your heirs and beneficiaries? Or have you, not thought about that? We have, I'm an accountant, as Lynn said. I'm also a speaker and a writer. And what I see is, in my practice, I tell people, like, what if Debbie was killed on the way to work one snowy March morning? The next person who called the office wondering if their tax return was done, and we get hundreds of those calls throughout, April, March, sometimes into May. And if they're told, Debbie's dead, we don't know what we're doing, that person will be, picking up their stuff and moving it on to another firm, reducing the value to, my husband and kids of the business. If, however, they are told that, Debbie was killed on the way to work this morning, but, Joanne will have your tax return finished by the end of the week, then, you have something going there that will help with the business. And what I have thought about is, there's a period of mourning when someone finds out their accountant's dead, but it's probably about 10 seconds long. And then it's, oh my goodness, what am I going to do if I'm not able to get my tax return done at Peveril & Associates? And, your clientele is going to feel the same way. If you're not open to serve them, then they are going to be looking elsewhere. So we do need, again, to have the planning. So the first section around, there's sadly, there's some hard truths around selling your business. It's, not all roses and sunshine. We're going to talk about selling to family and work on a timetable for you and how far out you are from selling the business, what you should be doing now. So the 6 hard truths. There are almost always more businesses for sale than there are buyers. There are, and well, I've got a slide on most of these, so we'll get to that. For a business owner, the value of their business to them is probably more than the value of that business to anybody else. So buyers will say, well, I don't think it's worth what you think it is. Almost 100% of the time. That's the conversation that I have when I'm helping a business sell or when I'm helping a business buy. A lot of buyers don't have any money, particularly if you're thinking about selling to employees or to children. So if getting money out of your business when you sell it is a part of your plan, selling it to the children may not be the way to go. A lot of people would rather start a business than buy it. And, when I'm talking to entrepreneurs and I ask them, did you buy the business? Many of the times the answer is no. They started it, but now they hope to find somebody who will buy it. Goodwill is a big chunk of the value of our businesses, and it's hard to finance that. If the person coming to buy your business doesn't already have a bucket of money and they're looking to borrow, they may not be able to borrow money to pay for the goodwill. And again, we're going to get to all of this. And it takes time. If somebody tells me today, I want to be out of this business by the middle of December, they are not going to be getting the best price because that's not very much time to find the right buyer. So taking that from the top, boomers are selling their businesses still, even though a lot of boomers have moved into retirement age. Not all boomers have sold their business, and there's a lot. I'm a boomer. We're the biggest cohort in history, et cetera, et cetera. So when all of that goes on the market, it does suppress what we see as demand. And some, excuse me, some businesses are harder to sell than others. The law profession in our province actually has stuff on their website letting people know how difficult it's going to be to sell their practice, because there aren't a lot of people coming in to that profession, similar with accounting, that are wanting to work for themselves. A lot of people in age groups, younger than the boomers, are more interested in work-life balance, and having a business doesn't tie into that. They want something that isn't going to be so time consuming. We see that in the medical profession. It's part of our issue at the moment is, as I keep saying, every time a boomer retires, we need to find 3 millennials to take over their medical practice, because the boomer was working 60 hours a week and millennials would like 20. And, that's kind of humor, but you may see that in your own situations as well. So when you've got more businesses on the market, then you have people interested in it, then the value goes down. But there are pieces of businesses, like I have clients who are running a massage therapy business, say, in a house. Well, the house is worth more than the business, and you are going to see that. Those of you that have property values are up, even if we're not seeing a huge increase in business values. Excuse me. And if you've got a good business, there's still a demand for good businesses, but it may not be as high as it would have been, a few years back. So this business owner is overstating the value of their business. For most of us, our businesses are like our babies. They work perfectly for us. They're worked around our lifestyle. They're exactly what we want. The goodwill that is in a business may not be easily transferred to someone else. I had a dental practice, and the dentist sold that practice to she was a very mature woman, and she sold it to a person I thought might have been a 15-year-old gentleman, very young. And the deal they made, because the outgoing dentist was very concerned that the clients coming in they would be more used to a mature woman. They wouldn't be excited about a very young man. They didn't fix the price until a year after the business sold. And the deal was whatever patient stayed through that year, the new dentist would pay for, but they wouldn't pay for all the ones that they predicted would leave. So that, is another example of how hard it is to, finance goodwill. So for the kinds of businesses where, we're talking about inns and B&Bs and restaurants, it may be a little less of a personal relationship than what you have with your dentist, your doctor, your accountant, your lawyer, that type of thing. But there's still a value of that person who's running the business and has all the relationships with the repeat business clientele, all that sort of thing. And when somebody new takes it over, that goodwill may not be transferred to the new person right away. And we have ways of dealing with this. If you've got somebody you know is going to take over the business, we'll talk about this. You bring them in early, years ahead of time, and you get your clientele used to them so that there is a way to transfer some of the value of the business to a new person. Most buyers don't have any money. This is true story. You will probably be able to sell the business for the value of whatever property you have, because the property can be financed with a mortgage. Anything over and above that, goodwill, it's going to be hard to finance, and the person who wants to buy it from you doesn't have the money just to pay for it. So the clearest example of people who don't have any money are your children and the employees. So, I run into this quite frequently where the parents feel that it's a family business and they want the children to continue running it. And, I'll say this now and I'll probably say it again. We do have to have that conversation with the children, a very frank conversation with the children, because this is so emotional. The kids who love their parents don't want to say they don't want to run the business because they know it's going to hurt their parents' feelings. And the parents hopefully don't want their kids to do things that they don't want to do. Everybody, should have enough of a relationship here that we can have this conversation about whether they want the business or not. And if that's clear, if you want to do something for your kids, it might make more sense to sell the business to somebody who has money and give the kids some of that money than it is to give them the business. So we've got a few more things on that coming up, but it's something to think about, because I have found particularly I guess my male clients are more likely to think that their kids want to run the business, and they may be wrong. More businesses are started than bought. I have written books on how to start a business as well as books on how to sell a business. It is far easier to start a business than it is to go buy something. In general, I mean, if you're looking at, hotels and restaurants, if they're already there, maybe, if you can come up with the financing, that's easier than going out and, doing all of that infrastructure yourself. So a lot of cases easier to start. You don't have to borrow much money. And there are lower barriers to entry in some places just to start your business, particularly service businesses. You just put your shingle out, and maybe people will come to you, particularly in the trades, although I don't believe we have any trade reps on this call. But if you're an electrician or a plumber, you're going to be in demand as soon as people know about you, because there's a lot of shortage in that area. Hard to finance goodwill. I've said this, it's ephemeral. When you think about what is the value of your business, it is the value of the properties. But it also is the value of the fact that it's a business, not just a property. How would we finance something that the banks can't repossess? So back to that later. And it takes time. Good price, you need to wait for the right buyer. I typically tell people it should be, we have a 10-year timetable, which we're going to get into in a minute. And it takes at least a year from you saying, okay, this is it, I want to be done shortly, before you're going to find the best price. Now, you might get a price quicker, but if you want to find the best fit for your business, then, on average, that's a year. I said this already, when you're selling to family, we've got this whole conversation required. If your kids do have money, that's interesting. But if, then it's a little bit of a different conversation. The question about if you have more than one kid, now you've got confusion sometimes, because are they going to run the business together, these children? Or is it that one person in that one kid, one of your children is going to run the business, but the other ones are not? So if you're giving the business to one child, what are you giving to the others? Do you want to be fair? Hopefully, yes. And if any of this is done in a will, then it has to be more equal, because we have legislation that requires you to provide for people that you're related to more or less equally, or explain why not. And, that's a legal thing. But if you have one asset and it's your business, then if you're planning to leave it just to one of your children and you have other children, you should get some legal advice on that. If you have employees and you're going to leave your business to your kid, Do the employees agree that the owner's kid is the best choice to be their new boss? If we're going to do this with family members, then I typically would want the children to go work somewhere else and get some experience that isn't in their own restaurant, inn, hotel, whatever, so they see how things are done other places, and they have some experience to come back to the family-owned business and be able to be a better choice anyway for a boss. Your employees, you may not hold on to employees if the boss's kid's in charge and isn't qualified. And as I've said, it may not be the kid's passion. We would like to know what the kid wants to do. So the timetable, 10 years out. Is your option going to be to bring a younger person into your business and start grooming them to take over at the time when you want to sell? Or to be ready if that meteorite comes and strikes you, that person is ready to step in to run your business smoothly from that day on? You do have to value the business. We'll talk about that this morning as well. Do you currently have enough value in your business with the other investments you have in your EI or your, OAS and CPP that you could retire? You've got enough money to live on? Are you there yet? If not, how far away are you from being there? One of the calculations, of course, around retirement is how many years are you going to live after you retire? So how much money do you have to have set aside for that? And, I have things to say about this all the time because somebody will come to me and say, how much money do I need to retire? Like I would know. And I say to them, when will you die? And I get those baffled looks back. Well, I don't know that. And I said, well, then how can I tell you? If I don't know how long you're going to live, how can I tell you how many years worth of RSP you have to save up or how much you have to sell your business for so you've got enough money? We can do estimates. If you live to be 90, here's how much you need. If you live to be 100, and some people have public sector pensions and they're okay. They're going to get the same pension every month until they pass away. That's easier to deal with. So value the business. Is it enough yet, given our assumptions? And does this business have what buyers want? And, that's a conversation we'll get to with valuation. What does retirement look like for the owner? I have had so many people who have retired. We've done all the calculations and, told them you can't do this business for 3 years after you retire. You've got a non-competition, et cetera, et cetera. And 6 months after they retire, they're so bored that they want to do something business-like, and they cannot because we made a deal with the new owners that they wouldn't be in that area for 3 years. So, some business owners don't do much but business. And I personally don't have a lot of problem with that, but then what are they going to do when they retire? One of my guys told me, I said, I can't see you retiring. I just think you're not going to do that very well. And he said, I've got a list. I said, okay, is it a long list? He goes, yes, it's a long list. 6 months after he retired, he was through the list. He had done all the things he'd set up. He was kind of bored. Some people will say that once you retire, the next thing on your list of things to do is die. And there's statistics around this, how frequently people pass away shortly after, within a range of retirement. So we need to come up with a number of hobbies. So there's something to be done during retirement and start thinking about when. So we'll think about that for a few years, and then 5 years out, we'll come back to the value of the business. Is it going up? Well, hopefully the value of the business is going up. But if you were running a video rental store, a few years ago made a big difference because that technology changed and the value of that business has gone from whatever it was to nothing because people don't rent VHS tapes anymore at scale anyway. Tax status. Something else to look forward to in our conversation this morning. I'm going to talk to you about the difference between selling assets and selling shares. If you sell shares, then your business has to be active. And in order to be active, it can't have more than 10% of its assets in something that isn't active, like cash. And if that doesn't make sense, we are going to talk more about it. Have you figured out who's going to buy it? And, how about those hobbies? 3 years out. Well, the value of this business is becoming much more important here because this is what we're hoping to get when we sell it. Are we on track for having enough money for the owners to retire? Have we got a buyer in our mind? If we've got kids, have we checked in with them? Again, with the hobbies. Now we can start thinking about things like employment agreements, contracts with clients, leases. If you're in leased premises, there's something in the lease agreement that says that you can't just transfer that lease to the new owner unless the landlord says it's okay. You want to start thinking about that kind of stuff, even around equipment if it's leased. Can you get any clients under contract? Do you have contracts for events that happen every year that, prove that there's an ongoing value to the business? And I would think about the technology as well. I've seen a few restaurants that were sold that didn't have things like, you had to pay cash when you came there. They didn't have a debit machine. There wasn't a way to order online. Some of that stuff wasn't in place. And the new owners, of course, immediately did that. I think that the business would have sold for more if the old owners had have done that. They would have shown more value. So then when you're a year out, now we're actively looking for a buyer. Please don't put a for sale sign on the building. If you do that, then people will think that the business is done, that you're selling out. It's important to do this first bit of looking for a buyer kind of, not secretly, but casually. You don't want to scare off the, existing clientele that you're for sale. Again, with the value of the business, can we get any employees under contract? And that way it's easier for the new owner to take over those employees. But as we'll see in a little while, sometimes the new owner doesn't want the employees. They want you to lay them off, pay all of their years of severance, and then they will take on the employees that work there that they want to have, but without all those obligations of prior years' service that would affect the severance pay. Talked about the leases. Again, with the hobbies. In the family situation, we should know what's clear now. Okay. Lynn, I don't know if there's any questions, but if there are, we're just changing to another section. So let us talk about valuing a business. So I get this question almost as often as I get the question, how much money do I need to retire? And this question is, what's my business worth? And every time, because I am a smart ass, I will say, whatever somebody else will pay for it. And they'll say, oh yeah, well, that's not helpful. I said, it's not helpful perhaps, but it is the truth. We don't know what anything's worth until there's a transaction. And you think about the transactions in your life. When you sell a car, you might think it's worth a different number than the buyer thinks it's worth. And we don't know until it happens. So we can make guesses, but I'm increasingly interested in finding a psychic that will help me plan for the future, help me look at things like this and say, oh yeah, that's what that business is worth because I see the buyer. That would be really helpful. Again, that's what passes for accounting humor. What about this personal goodwill? So if I was selling my accounting practice, and in July, many years, I'm willing to sell my accounting practice after 6 months of tax season, it is worth 1 times revenue. Okay, that is one of the ways we value a service business. What was the revenue? 1 times that revenue is the value of the business. That is considered to be the value of my client list, and it would be characterized as goodwill. How do I transfer that to somebody else? And again, I own a building in Sackville. I'm sitting on the 3rd floor of my building in Sackville. The 3rd floor is my floor. If another accountant came in, they could inherit the space, the clients, my staff, and there's some value to that continuing as a going concern. Is every one of my clients going to stay with somebody different than me? We don't know that. And there would be some assumptions made about whether that could be transferred. Other things, life cycle of a business, I already mentioned video rentals. Is your business on the upswing? Is it going to be worth more in the future? Is it in an area of it's seeing growth? Is it in an area that's now being bypassed by a highway? What's going on with this business and how does it impact what you could sell it for? So there's 2 basic approaches to valuing a business. Liquidation, which is selling it for the value of its parts. And I already mentioned this, like with a massage therapist owning the property. The property is worth more than the practice. So the liquidation value of that business was higher than the going concern value. because one of those assets, being the house, was worth more than the business. And I've seen that a couple of times. I had a corner store with a restaurant that they wanted to sell as a corner store and a restaurant. And we weren't getting anywhere near the price we were hoping for. What we did find was that, a place like Tim's would like that corner for a drive-through. So it's sold for a completely different purpose than what my client had been operating it as. So that, made a difference. The formula for personal goodwill. Okay, sorry, that's a question. So what it is in a professional practice is it's one times revenue. So what we look at is if you were to come in and run a business, you would expect to bill the same amount in a year that the previous owner was billing. And that is the value of, that whole practice, not necessarily just the goodwill, but that's the value that kind of goes away if the clients don't like the new accountant or the new dentist or the new chef. That kind of value disappears. And I've got some other kind of formulaic things we'll be talking about. So liquidation, we sell the parts. Going concern, we sell it as a business. Those are two different things. Okay. So let's talk about going concern. So a subset of this is just two different ways to value a business as a going concern. So we will take a look at what is each individual asset worth. So if you're running a restaurant, you have ovens and stoves, you have tables and chairs. What does all this add up to? Do you own the building? We would value the building. What about goodwill? What about intangibles? You have things like your menus, your recipes. They are not recorded on the books. One of the things that happen, accountants, because of the rules, we are only allowed to record as an asset something where there's been a transaction. So if you have a client list, which is really just the people that come to your location, you didn't buy that from anybody. So there is not a value on your balance sheet, because the rules are we only record things that we've paid for. So if you have goodwill that builds up over time, intellectual property, that type of thing, it's not going to show up on your financial statements, but it is there. And your assets that you see on your balance sheet are recorded at cost most of the time. You may have something different going on there, but generally the stuff that you see on your financial statements is what you paid for it. So if you bought the restaurant 15 years ago and you own the building and the land around it, or the inn or the hotel, then it is on your books for less than you could sell it for. You need to have a valuation in order to figure out what the value is of those kinds of assets, hard physical assets, land, building, because they have gone up significantly in the last decade, and your value on your balance sheet is not the most accurate value. It's not value at all, it's cost. That would be an important thing for you to think about. The stuff on your financial statements is at cost. What you want to find out is the value of them. So one of the things we do is we value every one of the assets. That, what is that word? And that's value, not cost. And the other thing that people do when they do this more often than they do anything else is they say, okay, we made $10,000 or $100,000 last year. That means that if we use the standard multiplier, which is typically 3, then that business is worth $300,000. Because
Debbie, can I just interrupt for a second?
Please.
I just had a request to repeat the formula for personal goodwill.
And I saw that, and that was the one times revenue.
Okay.
Which I'm going to say more about as we continue, but that was the formula I was talking about, was one times revenue. So I think I'm supposed to click something in that Q&A, wasn't I? That I was going to answer it live or something.
Okay. I've made note that you're going to answer this question live.
Okay. Thank you. That's helpful. Okay. So if you take a look at your balance sheet and you see all the assets that are there, what are they worth? You subtract your liabilities, that's one value. And there's more slides coming on this. The other overall method you do, how much money did it make last year? Times 3. That is another value based on the earnings of the business. So what is going on here? Here we go. So there are some issues, of course, in valuing. If you ask somebody to tell you what your building is worth, they're going to want to see, what was sold recently in the area that's the same as yours, and there may not be any good comparables, as the real estate people would tell you. But if there are, then that helps you to understand what they may sell for. Who is staying in the business if you sell it? So that's what I mean by management team. Are you leaving behind competent staff who can help the new owner run the business? And this is a problem if we're looking at a one-person business, because if you are trying to sell a one-person business, you can't sell yourself. There's rules about that. You are leaving that business. What is left in the business if you're not there? And that's something to think about, obviously, because it affects the value of the business. My accounting firm, I can sell because I've got staff and a building, clients. My speaking business, what I'm doing right now, there's nothing to sell here. When Debbie's lips stop moving, there's no value of this business. So I can't retire on the value of my speaking business. I could retire on the value of my accounting business. So it's different, different business, different things that you would figure out. Quality of the company's information. I'm a professional accountant, so I do audits and reviews. If I have a client who's buying a business, I would want to see that their financial statements had been reviewed at least by a professional accountant. If not, then I would go and try to do that work so that my client isn't buying a business based on unaudited information that may not be reliable. Is there still growth potential in this business? We are buying based on making more money in the future. Is that still the case? And how can you explain that to a new owner? And the life cycle, I explained that. You're probably not talking about highly technological companies here with tourism. We're talking about restaurants and inns and hotels and that type of thing. But is there still growth in this life cycle? Economic dependence, that's a pretty fancy word, but it makes it hard to sell some businesses because they have one customer or only one or two. You don't ever see a for sale sign on a Tim Hortons because there's rules about how they can sell them. And they do have complete economic dependence because they're not allowed to buy anything from anybody that isn't approved by Tim Hortons or Tim Donut, actually, in that case. So, is this a situation where you are trying to sell something and you only have one huge customer? And of course, we look at the overall opportunities, which, strong for tourism in our province. So the steps: value the assets on the balance sheet. And remember, this is the word value. It's not the cost. It's what you think they're worth. Value the assets that aren't on the balance sheet, like your client list, your goodwill, your intellectual property, recipes, websites, anything you think that would add to the overall value. Think about the liabilities. And, is there going to be any additional liabilities if you close the business or sell it to somebody else? I mentioned how the new owner might want you to lay off all your old employees. That's fairly common. And the reason they do that is because they don't want to take on any liability for years of service. Because if you lay somebody off without cause, you're typically going to pay them 2 weeks for every year they've been with you. And if that's 20 years, that's a lot of payroll. So that might be an additional liability. So in this option, the value of the business is the difference between the assets on the balance sheet plus the assets not on the balance sheet, less the liabilities. So that is one option, okay? We also value it based on, 3 times net income. That's another way of looking at it. So other things that we have to concern ourselves with when we're valuing: if you've got receivables, are they still good? Are the receivables for HST and you've been fighting with CRA for 2 years? Are they receivables from a trade show that you did and the trade show doesn't seem to have any money? So are they collectible? If they're not collectible, then they're not an asset and you have to subtract them from your valuation. We talk about credit risk. Whenever you have receivables, you have a risk you're not getting paid. And if all of your customers are in one place, one location, or one industry, is that a higher risk? Are all of your clientele involved in the fishing industry? And is this a bad year for the fishing industry? And the other common thing I see is related parties, that you have some information on your financial statements about money owed to or from a company that you also own. So because I have the 3 different businesses that I do, I will always have some back and forth between my accounting practice and my speaking business and my online trading business, that, there's some joint expenses, there's expenses that are all on the credit cards. There's always something going on there. And those things have to be off your balance sheet before you sell. That's important. Inventory. Are you selling inventory? Typically, what would we have included in here? If we've got restaurant, then we've got a minimal amount of inventory, presumably. If you are selling a store, however, then there could be quite a lot of inventory. And who's counting it? I have gone to a number of inventory counts where I'm there representing the buyer or seller. There's another accountant there representing the other. If I'm representing the buyer, they're representing the seller. We've got the staff there. We did one a few years back where we went over item by item, whether this was going to be on the inventory list or not. Expensive from a professional services standpoint to go through that. Is there anything in inventory that's obsolete? If so, nobody's buying it. Anything that you've got too much of? You've got a 2-year supply of something. Maybe the new owner doesn't want to buy it. Stuff you can't sell, well, clearly that's not going to be inventory. And, any products you're not selling at a profit. And some of this is acceptable. I think we all have something called a loss leader, where if you're trying to get people into a gift shop or another kind of store, you've got something that they come in to buy, and maybe while they're there, they buy other things. Milk and bread typically is sold at cost because that's sort of a staple, and they're always at the far corner of a store, so people have to walk by all the other things to get to them. And in that way, hopefully you increase your sales. So if you've got stuff you're not selling at a profit, it may not be adding to the value of your business. Fixed assets, any environmental issues. This building I'm sitting in, we had an oil spill 3 years ago. The tank didn't leak, but the furnace filter broke when there was some vibration from some excavation behind us. And we had a quarter of a tank oil drain into our basement. $115,000 later, we had that all straightened out. So I have some paperwork, certificate kind of thing that says there's no problem here. That's all been resolved. And the longer it is before I sell the building, the less likely that's going to be that it's a problem reducing the value of this property. But it's a concern. If there's ever been an oil tank, if there's ever been hazardous waste or any other things that affect the value, environmentally. So you've probably seen this phase 1, phase 2 type of consulting you need to get done in order to make sure that there's no problem with the valuation. If you bought the property, well, then you would have had it done at that time. If nothing's happened to it while you've owned it, then you shouldn't have any environmental issues. Current market values, that they're up for sure over what they were, a few years ago. Cooling off a little bit, I think, in the last few months. What I'm hearing from the real estate agents that are clients of mine is that, the market's steady, but it's not crazy like it was. And you may have noticed, you're seeing for sale signs that you actually see for a while before there's a sold sign on it. I mentioned already the alternate use of these assets. This is something to ponder. What else could what you have be used for? The building I'm in could be a residential home. It's zoned for either. It's never been a home, but it could be. And that may be a higher value for it than somebody buying it as part of their accounting firm. Particularly, and think about this, if I sold my business to Grant Thornton or Ernst & Young or one of those final 4 big CA firms, then they don't want the building, right? So that building could be sold to somebody else, and I could sell my practice to another accountant. And, you may have something like that going on. The types of assets that are not on your financial statements: intellectual property. So this is things like your procedure manual. And I have increased the value of people's businesses by documenting their procedures. And we test this. We have somebody who doesn't know the business very well. We give them our list of how to open the place in the morning. and see if they can, boot up the computer, get the coffee going, do all the things that would have to happen in order to run the business. The more detailed you make that, the more valuable it is, because it can be used as a training tool. And of course, if we have emergency succession where, that meteorite gets you, then that is a big piece of somebody being able to run the business until it can be sold. Customer lists or client lists, you do have people you can go out when you're having, the Black Friday thing for tomorrow. How many emails have you got this last couple of weeks about people who have you on their list and they want to let you know there's a Black Friday sale? That, I do triathlon. I have booked a couple of races in March in Florida where I will be, because it was 15% off to do it now instead of in February, because they're doing a Black Friday sale. I think you could make use of this if you are, offering accommodation or gift cards or something. So you've got lists, and those lists are worth something because you can market to those people. Trade name. The trade name is something that you actually own only if you've registered and paid for it. So that's a legal thing, but there is a way with the province to register your names, logos, that kind of thing, so it is protected, so other people can't use it. Websites. There are websites that are worth a lot of money. I don't know if it would be any of yours, but they have a value. And if it's already set up and it's tied into all of the reservation software, all those things, then it does have a value. And it's not going to be on your financial statements because it gets written off as you work on it. Logos. What do you think the Nike swoosh is worth? I've been told that the person who designed it got either $50 or $500 for it. If you put the Nike swoosh on a t-shirt or a other item of clothing, you add 10 to 15% to the value of that piece of clothing. So that's worth something. I don't know about your logos, but there's some, there's a value there. Phone numbers, phone numbers used to be a big deal, a taxi number or a pizza number. They were an interesting thing because you can't actually sell it because you don't own it. Typically, you only own it if you keep paying the bill, but it was able to be transferred. So, we used to make a fuss about this. A lot of things, including taxis and pizzas, are now apps. So is the phone number still of any value? Up to you guys to figure out, I guess, case by case. So there will be assets that are not on your financial statements that you need to include in your valuation. So what if it isn't going as a going concern? What if, your restaurant, hotel, inn isn't going to be sold as a business? And this sometimes, well, it happens for a couple of reasons. It might be worth more if you just sell the building, or it might be that you've tried to sell it as a business and you haven't been able to find a buyer. So now you're just going to dispose of it for parts, basically. So what could you get for each of the assets if you weren't continuing? So, if what we do is we figure out things like, if we sold who could we sell the inventory to? Who could we sell the receivables to? Well, that's a factoring company. Inventory might go to a jobber. We could sell the building to anybody who wanted to buy a building. It doesn't have to be somebody who's in our business. What else have we got? You sell the equipment, you sell the vehicles. We go through this. Or I have people that are just changing what they're doing, moving from being an operating business to just being pure rental. So they're getting rid of equipment, but they are continuing to rent out the building. And you might do that. You might sell the business to somebody, but keep the building and rent that building to the new owner. You might consider that as a way to take care of some of your retirement, because now you're going to have rental income every month. So calculate what each asset could be sold for, subtract the liabilities, and we've got another value, but this is based on liquidation. No value for intellectual property, no value for goodwill, just, and a lesser value typically than the value of a going concern. And I will calculate both always. I always look at the liquidation value and I look at the going concern value, because sometimes the liquidation's higher, or I want to have that number when I'm negotiating with a buyer, because if they're offering, 300 grand and my liquidation price, I think, is 350, why would I sell it for 300 when I could get more if I just sold the pieces? So you want to have both of those calculations kind of in your head. There's also two ways to liquidate. If you do it over time, finding the best buyer for the inventory or the equipment, finding the best buyer, the receivables, etc., you will get more for it. And you can hire people to do this, but they're going to charge you by the hour, and that reduces the amount you're going to get. But, one of my clients that closed up, they took them a while to get rid of all of the pieces of equipment they had. And it was probably more than a year later that they sold the last piece, but they got the price they wanted for it. They just waited, told everybody it was for sale, and finally the right person came along. So if you're doing it quick, you're not going to get as big a price as if you've got time to try to find the best buyers. There's some industry specific stuff. The ones I'm most familiar with, I told you, the professional services, it's gross revenue multiplier, 1 times gross revenue. Pharmacies is one. We had sold quite a few pharmacies for a while because Shoppers and Lawtons were buying out all the independents for a bit, and they were sold based on the number of prescriptions, which they call scripts. And it started out at about $38 a prescription that the business was worth. And it's down now to under 17 because there's been a change in the way that business runs with volume rebates and that at the end of the year. So it's not as profitable as it was, which changes that specific valuation. I don't have any specific valuations for restaurants or inns or hotels. They don't seem to have that specific valuation compared to what I showed you here, the services and the pharmacies. So tax implications. Everybody take a deep breath here. I don't have tons of calculations because I have found that people, it's too much to grasp. So we're going to talk about it without lots of numbers. So here's the thing. There is a capital gain exemption if you sell the shares of your business. So first of all, in order to sell shares, you have to be incorporated. So if your business has not been incorporated, you cannot sell shares. You could, however, incorporate your business before you sell it so that you can sell shares. Okay, so far so good. Another big advantage to selling shares is that you sell the whole business at once to somebody and you walk away. So if I was to sell my accounting practice, the shares, then Debbie, the owner of the shares of Peveril and Associates, would get $1 million from Grant Thornton and I walk away. They take over all the assets and liabilities of the whole corporation. They're the new owners. They're in charge. My work here is done. That is very attractive to people rather than selling pieces of selling assets out of the corporation. So if your business is incorporated, you can sell shares. You could also, though, still sell the assets. So if I was to, as I mentioned, sell part of the business to Grant Thornton because they want to buy basically the clients, I could sell the building to somebody else. So let's say I do that. I sell the building out of my corporation. My corporation has to pay tax on the gain on the sale of the building, the corporation, Peveril and Associates. Okay. And then Debbie has to pay tax when she takes the money out of the corporation. So any assets that are inside a corporation are subject to what we call double taxation because you pay tax when you sell the asset, you pay tax when you take the money out. Now, there are some complications in that. There's a thing called a capital dividend where you can take out, as the shareholder of a corporation, the non-taxable part of the gain. Right. I'm going to come back to that because one thing at a time. So in order to sell shares, which is my recommendation, that you would sell the shares of your business because there is an exemption right now, which is $1,250,000. So if you sell the shares of your corporation for less than 1.25 million, you're not going to pay tax on the gain on those shares. Most of us have a value of the shares of $100 or $1,000, which is what we paid for them when we incorporated our businesses. If you sell the shares for $1 million and you paid $100 for them, you've basically got $1 million gain. That gain is underneath this exemption. It's less than the exemption. So you are able then to not pay any tax on that, which, is kind of a good thing to do. And I tell people, here's what's on your list of things to do. Make your business worth $1 million, sell it, keep the money. 3-step plan, right? Okay. So the business has to be incorporated, as I've said. You have to be a Canadian resident. You do not have to be a Canadian citizen, but you must be resident in Canada to use the exemption. And the business has to be what we call considered active. So we have 90% of the assets used in the business at the time of the sale must be active. So what does that actually mean? Well, let me go ahead and come back. An inactive asset is more cash than you need to pay your bills. So if you've got $1 million in the bank and you only have 700,000, well, what do you've got? You only have $100,000 of actual bills, then you've got $900,000 of cash that you don't need to pay your bills. That is an inactive asset. So that's going to cause us trouble. Other things that we don't think about that we should sometimes is cash surrender value of insurance. If the corporation owns insurance, and lots of companies do, the cash surrender value isn't active. So how much is it? If it's a big number, then we might need to transfer that insurance out of the company before we sell it. Rental property is not active. So if you have a situation where you've got a restaurant in the bottom of a building and you're renting the top out, whether you're renting it commercially or residential, doesn't matter. That is not active income according to CRA. And let me diverge for a moment. I think we might have people with campgrounds on the call. CRA has been very active in this area the last few years about whether or not campgrounds are considered to be active businesses. And the comparison seems to be that if you are running a rental property, that's inactive. If you're running a hotel, that is active. And sometimes campgrounds are in between because you have seasonal people there. If a high percentage of the sites in the campground are rented seasonally, then that percentage is considered to be inactive. If mainly the sites are used for people coming for a week at a time or a few days at a time, then that's perceived as more like a hotel or an inn, and that's active business. So there's been quite a lot of activity back and forth trying to figure this out. Is your business, in fact, all active if you've got a lot of seasonal tenants in your campground? So it's, something. But rental property, if it's designated as rental property because you are renting to somebody, that is not an active asset. So if more than 10% of the value of your business is due to the part of that building that's rental property, then you're not going to get the capital gain exemption. And, we might want to think about how you could fix that. If it's, obviously it's important not to pay tax. Investments. You have a whole bunch of GICs in the business. Bitcoin, who knows what you might have. They're not active either, right? And what about equipment that is inside the business but is not being used in the business? I have clients who have boats in their business and they're not on the water. The boat is probably being used for personal use, but it's in the business, making trouble for us. Same thing with, I've seen RVs in the business. There are things sometimes that should not be inside that corporation if you want to sell that corporation's shares and keep the money. Okay, so back to this. Okay, 90% of the assets at the time of the sale must be active. So what do we mean by 90% of the value? So if you're selling a business for $1 million, 900,000 of that value has to come from active assets. That we work hard on. You know, I've spent all kinds of time doing that with various people, getting the cash out of the business, getting rid of equipment that shouldn't be there, moving insurance policies out, because the exemption isn't a, you know, you can't prorate it. It's all or nothing. So you either qualify or you don't. And you know that it's very discouraging to have sold something for $1 million, assuming you're not paying tax on $1 million, only to find out that you don't qualify. And if you add $1 million to your personal income because you sold shares personally and it isn't an exemption, then up until the end of June or June 25th, you would have paid tax on half of that. We now have this complicated issue with our capital gains where the gain up to 250,000, you only have to add 50% of it to your income. But the gain over 250 each year, you have to add 2/3 of it to your income. That's called a capital gain inclusion rate. And there was a lot of talk about it when the rules changed. They changed in April, effective June 25th. We had people who sold a lot of rental property and other things, capital gains, because if they sold it after June 25th, they might have had to include 2/3 of the gain in their income. If they sold it before June 25th, they only had to include half of it in their income. Corporations who sell things from June 25th on have to include 2/3 of the capital gain in their income instead of a half. They don't have the 250 deal. So it's gotten a lot more complicated and also more expensive. There are people who are talking about how if there's a government change at the federal level, that rule might go away. There's prediction that the Liberals won't be repeating as in the federal government when the election's taken place, and that the Conservative government's not a fan of this capital gain rate. So we'll see. But at the moment, you know, if you have a capital gain personally, you include half of it in your income up to 250 and 2/3 of it after that. So that is a concern for you if you're selling assets when you sell your business, because you don't get the exemption. The exemption is only available when you sell the shares of an active business. Okay, so on the day of sale, 90% has to be active. On the 50%, for the 2 years up to the time of the sale, 50% of it has to be active. So the inactive assets, again, we talked about that. These are the ones that are not active. So here's a simple balance sheet, just so you'll see what I'm talking about here. And what we have in this business, we have $375,000 in the bank. Okay. We have $100,000 in current liabilities. So we have $275,000 more than we need to pay our bills, which means that 275,000 is inactive. So if we're selling this business for less than $2.8 million, we've got too much inactive asset. So this is, again, I'm hoping no one's ears are bleeding, but this is not, you know, a concern, because the amount of inactive asset you can have changes with your price. If you're selling a business for 200,000, then you can't have any more than $20,000 of inactive assets on the day of sale. If you're selling it for $1 million, you can't have any more than 100,000 of inactive asset, because it's 10% of the selling price. So we have to be really careful when we're negotiating that if the price keeps going down, we might turn the deal into something that is not going to qualify for the capital gain exemption. And you might remember this exemption. It was 500,000 for a while, and then it became 750,000, and they indexed it. So it's up to, before they changed it again in April, it was up to 950,000. And then the April budget made it 1,250,000. Nice round number. And that's each. So if you and your spouse own the business together, then you can sell it for 2.5 million before you pay any tax, provided it qualifies. So we do a lot of work on these balance sheets before the sale to make sure it's going to qualify. So what would we do here? We've got an extra $275,000. We would probably pay that out to the shareholders who would have to pay tax on it. But we're going to have to figure out how best to get this cash out of the business so that when we sell it, we can use the capital gain exemption. That's a big prize, to not have to pay tax on that money. Okay. So that is what it looks like when it doesn't qualify. You would look at your balance sheet, figure out how much cash you had that is in excess of your liabilities, and that would be the amount that you use to determine whether you're on side or not. So about selling the shares, for tax purposes, your best bet is to sell the shares because you'll keep more of the money. And what it means is that we can take less money from the buyer because we're going to get to keep more of it. And I will do that analysis. I will say, if you want to buy the assets of this business, then you need to pay $1.5 million for it. If you're willing to buy the shares, then we'll probably sell it for around $1 million. And the difference between those two numbers is money CRA is not getting, because they get a big payday when people sell assets. They don't get a lot of money when people sell shares. So if we can organize the transaction of selling your business in a way that you can sell the shares, then nobody's paying tax. And that means the buyer has to come up with less money. So we usually do those calculations and show it to people. Because why doesn't somebody want to buy your shares? Well, the word there is usually what we call compliance history. If they buy the shares, then they become liable for anything you may have done in that business that somebody could still sue you for. So you're going to perhaps have a tax audit. That's the common example. And the tax audit might mean that you owe a bunch of money, but you're the owner, so now you have to pay it. So we can cover some of that off with agreements, which we'll get to shortly. That you have an indemnification agreement, which means that you buy the shares of the business, you find out there's some bad stuff there, the previous owner agrees to pay you for the costs that are recently discovered. So to sell the shares, you got to make sure it's going to qualify, and you have to have a buyer who understands. And this can get complicated. I've tried to explain it as simply as I can, but there are a lot of little things that make it more complicated. But I've had clients come to me and say, I've got a deal, somebody wants to buy my business, and I'll say, you're selling shares or assets? And they tell me they don't know. Well, this is bad, because if you're selling shares, of course, you may be able to keep a bunch of the money. If you're selling assets out of a corporation, then you're going to pay tax in the corporation, then you're going to pay tax when you take the money out. So what if your business isn't incorporated? If a business is not incorporated, then there's often no balance sheet to show anybody, because the business has only been filing 2125 forms with their personal return. They haven't been preparing balance sheets because they don't need to do it for CRA. A lot of financial reporting is pretty much driven by what CRA wants to say. So how can we show the buyer the assets of the business when there hasn't been a balance sheet prepared? Well, you can do one, of course. That would be a possibility, but you won't be able to do one that you've filed with CRA and people accept as being the truth, because you've been filing it with the authorities. I find it hard to talk about how profitable the business is, because typically successful businesses get incorporated. The corporate tax rate in Nova Scotia is about 11%. The personal tax rate, if you're making, more than 100 grand, 150, is up around 50%. So if you were making a couple $100,000 in a business, you would be incorporated. So the businesses that are not incorporated, we kind of know right off that they're not making enough money where incorporating would help them. So it's not a big business. It's not a wildly profitable business. We know this already because it's not incorporated. There is no tax savings for selling an unincorporated business because there is no shares. And I'm saying it again, the exemption is only for the sale of shares. So an unincorporated business, when you sell it, it's all personally taxable, unless you have partners. If you have a partner, then when the business is sold, your partner pays tax on half the money, and if it's half and half, and you pay tax on the other half. You also have to get your partner to agree to sell. So hopefully you have all those agreements. Sometimes, I would suggest that if you have a little time before the sale, if you are going to have a gain, it might be worthwhile to get incorporated before that sale, so you can use the capital gain exemption. Capital gain exemption is that big a deal. And you might have heard that you have to be incorporated for 2 years before you sell. Not the case. The business, you still have to go back and look, was it 50% active for the last 2 years? But if you incorporate a business that's not incorporated, you can use something called a Section 85 rollover, which sounds impressive. And you can do that to move the value of your proprietorship or partnership into a corporation and not pay tax on that transfer. And then you don't pay tax when you sell the shares. So I always say at this point, you talk to your own lawyers and accountants before you would go ahead and do this. What we're talking about here is more educational than specific tax advice, because there could be things in your situation that make a difference, particularly if you're a Canadian resident but not a citizen. A lot of the tax problems I'm dealing with at the moment are American citizens who are Canadian residents. And whenever they sell anything, we have to pay tax in both countries, and the States doesn't recognize that capital gain exemption. So it will be taxable in the US if that's a concern for anyone. So if you're not incorporated and you're thinking about selling, it's probably worth your while to get incorporated if there's a value there. Sales process. This goes on for a little bit. I'm not seeing any questions, but so I will carry on. We're going to talk about the different types of buyers that are available, how you're going to pick the best offer. Let's assume you've got multiple offers while we're being optimistic here. And, the agreements that you need to have and which one of them you can deal with and which ones you're going to need other people to deal with. So the types of buyers. So taking them from the top, what if you have another shareholder in your business? Okay. If you are in business with more than one person, then hopefully you have a shareholders agreement that governs when you want to leave, and you'll look to that agreement to figure out what to do. You also might be able to sell to a competition. People that want to have more of what you've got, we see some consolidation sometimes in various types of operations. The veterinarians lately have been all getting bought up by bigger companies. They see that like the way the pharmacies went a while ago. And, we may see that with restaurants and inns, who knows. Customers, do you have a customer who so likes what you do that they might just buy it when you're leaving it? Your employees, and then of course, strangers. So the existing shareholders, I'm hopeful that you have a shareholders agreement, which you will then look at and see, what does your shareholders agreement say about you wanting to retire? Typically, there will be something in there called a right of first refusal. So if I'm in business with Lynn, I can't sell my shares to Joe without asking Lynn if she wants to buy them first. Right? That's the right of first refusal. We also would have something called the shotgun clause, which I'm a big fan of. So basically, I'm in business with Lynn, and I would say to Lynn, I want out. The price is 100 grand. Her choices are to pay me 100 grand and I go away, or she could take 100 grand from me and she goes away. So it's a very, I think, elegant solution, despite the fact that it sounds violent, in that if I pick the price, then Lynn can take it or pay it. So is it a fair price? But it resolves issues. You may have run into people who have all kinds of issues with their partners, shareholders, because they don't have a good way of resolving issues. If one of them wants to do something and the other one doesn't, they may just be at an impasse. They can't move forward. So this kind of a clause means that, it's typically 30 days. Within 30 days of Lynn and I being in business and one of us pulls a shotgun clause, then that business will be being run by one of us only. And that's a resolution, rather than some of these things that have dragged on for years. So the other thing that should be in your shareholder agreement is a method to evaluate an offer. I mean, the shotgun clause is fine for dealings between you and your partners, but if somebody offers to buy part of the business, how are you going to value it? And what we've done with some of the more complicated ones I've looked at is we do a valuation and we explain the approach. So, we valued all these existing assets. We valued the ones that aren't on the balance sheet. How did we value it? So that the next time we want to do a valuation, all we have to do is change the numbers. We've already agreed on the methodology. And that's important if you've got a couple of different shareholders, because, what if one of them dies and you have to pay their surviving spouse, and how are you going to come up with the value? What if one of your shareholders becomes disabled or moves out of the country or whatever? There are things that might happen that you're not going to be able to talk to that shareholder about. So it's important that you have the shareholders agreements. And, I've had ones where we spent so much time building this agreement, and then, it's lawyers and accountants and tax specialists, sometimes beyond just the accountant, that work all this out. And then one of the ones I had, they never signed it. So it had no effect. They thought they had all, worked it out. And then when they started fighting and went to look at the shareholders agreement, it had never been signed. So useless piece of paper, as it turned out. So if you're in a business with other people and you want to get out, your shareholders agreement will tell you how that's going to happen. Competitors. Maybe you want to merge with somebody else. You've got a restaurant, they've got a restaurant, they're in different cities or whatever. You're going to put the same name on both. Now you've got more buying power. You can move employees around. You've got a better branding option because people see the name in a couple of places. So maybe it's not so much a sale as a merger, and then, down the road, maybe you get out. Sometimes your, competition is interesting in expanding. They may also want the opportunity, if you're looking to sell, of making sure that somebody else doesn't get your spot. So this is the, kind of the group we go to, carefully, to see if there's any interest. And it's a pretty casual thing. You could ask a shareholder, if I was ever thinking about selling, do you think you'd be interested in buying, without giving them any information at that point, just to see if there's any interest, because it might just be a big hell no. I personally am trying to get out of this business. I wouldn't take on what you've got. Whenever you're giving financial information to a potential purchaser, you get what's called an NDA, a non-disclosure agreement, signed, which basically punishes them if they tell anyone the information that you're sharing with them. So, you have an accountant who shares this information with a potential client to, here's something you might want to buy, look at their numbers, whatever. If that person then goes and tells somebody else those numbers, well, they've broken the non-disclosure agreement. And what is your remedy, as they say? Well, typically they have to pay some money, but in order to enforce that, you often have to hire lawyers who then make money trying to enforce something to get you money. If you're going to talk with your competition, they're going to want to see your numbers, and you want to be sure they're not just tire kicking. Maybe they are interested in finding out how you're doing, so they're going to pretend that they're interested in buying the business just to get an idea of how it's going with you. And I don't know a good way of figuring that out besides just trying to understand them and what their motivation might be and the conversations you have with them. Because once, they're probably the people you don't want to have your numbers, and you are going to be handing them to them. You want to think that they're serious about it. We have asked people to pay a price to look at them. So, if you're serious about this, you sign the non-disclosure agreement, you give us $4,000, $5,000, some number that's enough, hopefully. And they pay it to look. And that amount could be taken off the purchase price. So if they do buy it, you can give that back to them. that hopefully discourages tire kickers, or at least tire kickers who, are unhappy about spending $5,000 on a piece of paper. So your competition might be a good way for you to find somebody who can buy the business and will continue to operate it. Customers, I run into cases where some of the customers are bigger than my clients. And, I have several times sold businesses to the Irving Group. The ones based in St. John, Newfoundland, New Brunswick. They have a whole mergers and acquisition department, and they are often looking for things that they don't already have. Where would it fit into their supply chain? Do they have anything in that area? I don't know about that particular group moving into, restaurants and inns and hotels and stuff, but other businesses, those people have been interested in buying it. So if you've got any customers, you might have people who stay at your place and say, oh, I'd really like to own something like this someday. Keep track of that, because they might be a good person to get a hold of when the time comes that you are in the market to move the business along. Now, is there, because we're racking our minds here at this point, who are we going to sell this to? Because the more people you can think of that might be interested, the better the chances are you're going to find the right buyer. Because the right buyer is somebody with money who is willing to pay you a good price. So are there customers who would be interested in this? Employees, we've already talked about family members. But your employees don't have any money either. And somebody who's working for you, if they have a whole lot of money, how did that happen? Is there money missing from your cash register that your employees have so many bucks? Or maybe they inherited money. That does happen. If you're going to turn your business over to the employees, then you're probably going to wait for your money. And that's a conversation. How long are you willing to wait for your money? And is there a possibility you're not going to get it? Well, there's always a possibility you're not going to get it. I have a client who's still operating a business who has sold it twice. And I've been teasing him that his new business model is to sell the business and then repossess it when the new owners can't actually run it. And it's not a tourism business, but the way it has worked, the first time he sold the business, and 3 years after the sale, the person wasn't able to continue to make the payments. So he repossessed the business, ran it again for another, 5 or 6 years, sold it, same thing happened. And now he's running it, and he's older now. He's just going to close it when he's tired of it. But he sold it twice, and he's made money on it, of course, both times. But the remedy in the agreement was, if you don't make payments, then we're going to take the business back. And if you don't want to run your business again, this isn't a very good remedy for you. You've sold the business, and the people that are running it aren't doing a very good job of running it. And you're going to end up having to take it back because you didn't get all your money. Ideally, the people who are going to buy your business are going to pay for all of it at once, and you're not going to have to worry about it again. And that's, some of the problem with selling to family. If you're selling to family, then you're never going to be free of that business, if that's a goal, because your family members are still going to be talking about it and, asking you about it sometimes, or you're going to know what's going on because you're still involved. Then there's strangers. Who is the person? Where do you go from here? Okay, you've ruled out family, employees, competitors, customers. Now you're down to finding a buyer you don't know. This is the point at which you might contact a broker, a business broker, who can then start shopping around your business to the places that might be interested in it that you haven't thought about. I get information from business brokers fairly frequently. They will say things like, I have a client on the South Shore who is running this kind of business. They'll give you a paragraph or two about the price range, anything about it that might be important in a paragraph. And, do I have anybody who's looking? And at the moment, I don't have a single client who's looking to buy. I have probably more than a dozen people who are thinking about selling or are in the process of actively selling. And that's probably because I am also an old person and my clients tend to be my age. So people are, getting out of that business. But somebody who's looking to buy typically would reach out to local accountants or whatever to see, what is available. So we do kind of keep track of who's interested. If somebody was looking to get into a business and they contacted a local accountant, they probably have, a few people who they could point them towards. Doesn't happen as much as it used to, but the brokers are still, brokers are doing things. They will, of course, get paid for selling the business. So if you can figure out a way to sell it without getting involved with the broker, then you're going to save some money, but the broker will probably get you a better price. And as I said before, you don't want a for sale sign on the premises because that lowers the value of your business. For sure. Because, if I know that a business is going to be sold, then I would probably start looking for where would I go if I couldn't go there. I've heard this about certainly professionals that, when somebody says that they're looking to sell their dental practice, or you can't sell a medical practice anymore or a legal practice, then I would go find my own dentist. I wouldn't wait to see what dentist bought that business. So, if you've got a sign on the door, you're already looking like you're in trouble because, why is the business for sale? What's going wrong here? Okay. Moving on to the best offer. We do have time for questions, so if anybody's got anything, please let me know. How do you figure out the best offer? So this is optimistic, of course, that you're going to have multiple offers to choose from, but typically we would have, hopefully we'd have more than one. So how do we evaluate it? So I would work on a point system, which I would be happy to help anybody with. But here's the things that I would want to consider in my point system. If somebody has all the money, I'm selling my business for $1 million. If anybody offers me $1 million on closing, then I'm going to give them, let's say, 50 points. Right? I mean, you get arbitrary how many points you would give, but I would say it's 50 points for having all of the money on the day of sale. It is 25 points for having half of it, that kind of thing. Big points for a share sale, as far as I'm concerned, because that way I'm hopefully sheltered. I don't have to pay tax on most of the money. So that makes me happy. I would assign a scale of timing. If somebody is going to give me all of the money and they're going to do it by the end of December, well, the end of November, let's say, then they get a bunch of points for that. Then there's the agreements. If they want me to sign a non-competition agreement for 10 years, they lose some points for that. Even though I'm not saying that, but my clients always say, oh, I don't care. I'm never going to do this again. I've signed a non-competition agreement for 100 years. I don't care. But then they do care. So I try to keep this to a minimum. No requirement for the golden handcuff, sorry. Typically, if somebody is buying a business, they want the previous owner to stick around. For how long, right? No matter how long it is, they usually don't last that long. I have a guy who's currently working out a 2-year earnout, and I think they are both really tired of each other at this point. I think that's not going to go the full 2 years, but we'll see. The typical 3 to 6 months. So let's say I'm hanging around as the previous owner, and the employees who worked for me for years now don't work for me anymore. They work for the new person who they may or may not respect as much as they respect me. So I'm telling them to do things, and the actual owner is telling them not to do things. I am complaining that they've made changes that I think are stupid changes, and the new owner's eventually deciding I am no use to him in this organization, so they typically boot you out. So I would rather not even hang around. Why am I sticking around a place I no longer own? Most business owners, that's not what they want to do. If they wanted to work for other people, they would. They want to work for themselves. They're a problem employees typically. Right. So you come up with some kind of system before you look at the offers. And then you score them. What does this offer have? All the money? Yes. Share sale? No. Minus points for that, and that way you can do it without getting too wrapped up in, the emotional reasons, because you do have emotional reasons. Typically the employees or the children are going to be your sentimental favorites. You would love for the employees or the kids to buy the business, but they're not going to get a lot of points because they don't have the money. And again, you're able to do whatever you want, but if you're going to rationally evaluate the offers, then you should use a point system. What if you're selling it to a big corporation, right? They're probably going to change the name on the door. If Sobeys comes and buys your corner store, it's going to be a needs store. It's not going to have your name on it anymore. Same thing if somebody buys your hotel and turns it into a Marriott. I see a question. Oh, it's already answered and it's still showing as open. Okay, sorry. Okay. Maybe what's important to you is the legacy, that you want that business to still have your name on it in your community. So all that gives somebody hundreds of points for being the people who are going to buy it, but not change the name on the door, even though they don't have any money. So I don't think that, I'm going to look at it from an accounting point of view, from an actual calculation deal. And people who want to buy your business but don't have any money, that's not really what we're looking for here. Okay.
Debbie, I'm not sure if you did answer. If incorporated, what about a rollover and setting up a tax shelter for your cash assets? What would be the pros and cons of that idea?
Okay, I see what's going on here. I'm not used to webinars, Lynn. We usually do meetings. So there's an open tab and an answered tab. Okay. So yes, I can answer this question.
Okay.
So the deal with, your problem with getting the cash out of the business, if you're incorporated before you make the sale, is what do you take back? So I can say, okay, I'm transferring my extra 500 grand to a company. So the cash leaves the business, but accounting has two sides to every entry. So if the left and it's still a receivable, that's a problem. So the way we would have to do it, and you need tax specialists, is it would have to be a dividend going from your operating company to another corporation so that it leaves the balance sheet altogether. And we recently did something very similar. We set up a company just for this purpose, who owned the shares, and they had dividends paid on those shares. And that meant that the money left the balance sheet entirely and the business qualified. So that was very helpful to do it that way. But we did pay quite a bit in legal fees to get the other things, to get it set up and have all the documents written and signed to make it happen. So it can be done, but it probably wouldn't be worthwhile to do it for, less than a few hundreds of thousands of dollars because of the costs involved.
Okay. So if you sell a business and they pay you over 10 years, do you pay tax on the whole amount in 1 year, or do you pay tax only for what you receive each year? That's a good one.
Yeah, that is a good one. And it's a very complicated answer. So the deal is, yes, you should only, the first year, you will only pay tax on the money that the gain on the money that you actually receive. So this is actually an ideal way to spread a gain out so that you don't go over the 250,000 each year under the rules we currently have, so that you would only have to include half of it in. So what you're doing is you're taking a reserve every year for the amount of the gain that you haven't received yet. And, there's a couple of calculations that you do on the tax return, but it's not terribly complicated. The complicated part is you can't go more than 5 years. So at the end of the 5th year, even if you haven't got the money, you're going to have to pay tax on the whole amount, because they have made a rule that these vendor takebacks, or any other reserve you're taking for capital items can't be longer than 5 years. So you can spread it out over 5, but you won't be able to spread it out over 10, just because of the rule, not because there's any, other logic. So
Okay, that's great. And this is a very good question. Is there a way to chat informally once Debbie has done your formal presentation?
well, that's a technical question. Well, yeah, I don't know. What could we do with that? We'd have to get rid of the webinar part and make it a meeting, wouldn't we?
Yeah, I don't think I can switch it.
I don't know that.
Yeah, but I think once you're done, it's going to be easy enough for me to manage the questions. So
Okay.
I think
Well, we could, yeah. I mean, I'm happy to chat informally. I have set aside time for questions, for
perfect.
sure in our
So
time.
Heidi, hopefully that works for you.
Yeah, can make that happen.
Okay.
For sure. Okay, and that's what's in that question. Okay, so the questions that we currently have are answered. So my point system around, figuring out the best offer. So what we would see is you would choose the best. The buyer who meets the price for a share sale, pays it immediately, doesn't want the owner to stick around. And, I make a joke that that's like winning the lottery, and unfortunately, maybe just as likely as winning the lottery, that you're going to find this ideal buyer who's got everything you want immediately. But, what we would normally do if we're evaluating a number of offers is we would pick the one that has the most points. And if we're being logical, we're not always being logical. Sometimes we're being, so attached to our business. Agreements that we need. And this is important because it'll surprise you how many there are, for sure. The first thing we start with is a letter of intent. So it moves from there. The letter of intent can be as short as 1 page. And what it is, I would like to buy your business for $1 million. It's a share sale. I'd like to do it by the end of the year. Okay. Actually, let's just do that. So it's a short, less formal document. You can do this on your own, more or less. You don't need to have a lawyer at this point, although it's not a bad idea to ask them. You are going to give them the price, what the asset or share sale, well, is it an asset, sorry, or a share sale? When, and are there any conditions? So typically, if you are the one buying, you would put in conditional on financing, conditional on getting your financial statements, that kind of thing. You would put a few of those little conditions in. So as the seller, you can accept that letter of intent the way it is and move on to the next step, which is the purchase and sale agreement, or you can reject the letter entirely. You can actually also counteroffer, although, that's less formal sometimes. You can just tell them, no, the price isn't enough, and, they can decide if they're coming back. You don't have to formally reject it or counter it, because it's not a formal thing. The purchase and sale agreement costs a lot of money, I think, compared to anything else you're doing. This is into the thousands of dollars usually that a lawyer will want for, drafting this purchase and sale agreement. And the question is, who's paying for it? Are you as the seller paying, or is the buyer, or, you're both paying your own lawyers, but who's doing the heavy lifting in drafting the purchase and sale agreement to begin with? You want to sort that out. Often it is going to be the seller, because that's how commissions work typically. And you're going to have the lawyers involved, lots of clauses. You got to read it. You got to try to understand it. You are going to pay money to have someone explain it to you. Because what's in there, some of the common things is you're going to have a non-competition agreement in there that you promise not to do this business for a time period. And, one of the things around non-competition, which, yeah, sorry, I've got a slide on that, so I'll say that later. But, are you going to sign a non-competition? Are you going to be employed after the sale? Confidentiality is an important part. Neither the purchaser nor the seller should be telling everybody about the terms of the sale, unless no one cares. But typically, you don't want information getting around what you sold it for. It's nobody's business but yours, but up to you. There is something called the indemnification which means that as the seller, you promise that you've told them everything. But if anything comes up after that happened at the time when you were the owner, that you will pay the costs of dealing with that. So, sometimes the common one is the tax audit. The CRA comes in and audits 3 years, and one of those years was when you were the owner, and they find, that you don't have receipts for things you claimed. So you have to pay the tax on that. You personally would have to pay the tax, even though you no longer own the business, because you signed an indemnification agreement that says that if this happens, you'll pay it. And I've had lawyers that have been quite worried about whether that money will be available. Depending on how much you're selling the business for, are you going to have any money in a couple of years if there's a tax audit that comes up? So I've had lawyers want to hold on in what they call escrow, some thousands of dollars of this money until the indemnification period is over. So up to, well, the lawyers will work that out, but the purchase and sale agreement typically goes back and forth a couple of times. You look at it, your accountant looks at it, people make changes. They make the changes, you talk about it again. Sometimes lots of time, there's a bit of a negotiating here. And the whole thing can fall apart at any point when you have, what we call a deal breaker, where we've given them information about our financials and they want to change the selling price, or, they want to put in a clause about something and we don't want that. At any point, the deal can fall apart before the purchase and sale agreement is signed. So, money being made by lawyers. The non-competition one, you agreed not to compete within a certain area for a certain period of time. It is typically not longer than 3 years, because the courts have thrown out ones that are longer than 3 years. I want to make sure that all the terms are defined here. And I'm sort of sensitive about this because I had a situation where a client sold an inn and had agreed not to do anything, and then was working at a restaurant that the purchasers of the inn thought was too close. And the measurement, if you drove on the road, was far enough outside of the area of non-competition that the former owner was in the clear. But if you did it as the crow flies, they were within that area. And of course, the non-competition agreement didn't define how it was going to be measured. If it had been defined, then we wouldn't have had the lawsuit that came about after that. So what you want to do is to make sure that you have enough information in the agreements so that you don't have to sue later on to clarify anything. So I've been paying attention to that one, like how is this distance measured? And sometimes it's simple, it's the whole province of Nova Scotia. Okay, that I can deal with. But if it's within 50 miles of the former inn, then 50 miles as the crow flies, 50 miles on conventional roads, like what? Okay. And I do watch out for the non-competition, because I've had so many people who said they weren't going to work again and have come back to work. So I no longer believe anybody who tells me this. Employment. How long are they going to stick around? What are they going to get paid? What are the duties? Do they understand they're not the boss anymore? This agreement can take a little while to put together. But you want to hammer that out, because if you have been a person who has worked for yourself for a long time, you are not going to be very excited about somebody telling you what to do. So that, we want to nail that down. The confidentiality, not to talk about the terms. But what's the deal if somebody does talk about it? Some of these things that I talk to lawyers about, like, you've got all these things in the agreement, but what happens if they don't do it? I run around and tell everybody I sold my practice for $5 million, but I promised not to say that. But I did. I told people. So what's going to happen? It's something we need to think about, because if you've got something in the agreement, but people are not adhering to the agreement, what's the consequences? And maybe you don't care. I've had deals where nobody cared. Like, go ahead, tell everybody what you paid. I don't, for whatever reason, it doesn't matter to me. So decide, do you want the people who buy your business to keep quiet what they paid for it. Because if you do, then you need to have it in the agreement, and you need to make sure that there's consequences if they break that deal. And indemnification. Applies, as I said, the tax audit, is this going to be in the agreement, and how long? We used to look at 3 years being as far back as CRA will go, but they've made some changes to that. They have decided that there's no limitation on how far back they can go for a property sale. So we would want to know if there was any issue about this, because people have, there's a lot more attention now to the sale of cottages or the sale of houses. And, if somebody sold a cottage, say 15 years ago, and they should have paid tax on it and they didn't because they figured they could get away with it. If CRA ever finds that, 15 years isn't going to protect them anymore because they've made a new rule about property. So I would take a look at that. If there was any property sales in the past of this organization and they weren't reported, then the indemnification period is forever, because if CRA figures it out, they can come back and look at that. Okay, that is the end of, well, it's pretty much the end of what I came to talk about. So what we did in this section is we looked at the letter of intent, which you will get informally from a person who's interested. And if you accept the letter of intent, you do a little negotiating back and forth to come up with the price, and is it a share sale, and when's it going to take place? Then you can move on to the purchase and sale agreement. Okay. The non-competition, are you willing to sign that? And, I would say don't be so fast to sign it forever, because it could be that, have you got this retirement really worked out? Do you want to work for the new owner? And do you want to keep things quiet? So that's what I usually say at this point. This is what I came to talk about. I have said things about all of these. I do know more stuff. I'm happy to answer more questions. I left time for that intentionally.
That's great, Debbie. I mean, incredibly thorough, and it is recorded, so people can go back and listen to it. But as Debbie said, there's plenty of time for questions. So I will open it up now and expect to see the Q&A box. There we go. So let's see if my little mouse is going to cooperate here. Oh my goodness. Oh.
Yeah, so this is more of an observation, but yeah, I do find that sticking around after you sold it hasn't been a selling point. In 100% of the cases I've seen, that it doesn't help the relationship between the buyer and the seller to actually try to work together for a period of time when there is a transition between, I know more about this than you, but it's not mine anymore. And this is mine, I don't care what you know kind of thing. It can get awkward pretty quickly. So I would really ask people to give a thought to their standard operating procedures, their manuals, their checklists of how you do things, so that there's value in having that information to pass over to a new owner, rather than the idea that you're going to hang around and train them. And particularly if, you have an emergency situation. I was very sad about this last year. We had a long-term employee who had a stroke and passed away. And, we were obviously sad about that, but we had always assumed she'd train her replacement. And that, of course, couldn't happen. Because she wasn't there to train the replacement. So, things weren't as well documented as I kind of thought they were, because everything changes all the time. So it's not just for the sale that documentation is important. It could be if, there's any kind of emergency.
That's a good point.
Yeah, and I think that it helps people to look at that, as opposed to, I'm not selling for 10 years, I don't need to worry about it, when you never know. So Laura, if you're not incorporated, no, there is no personal capital gains exemption. There was $100,000 one that they got rid of in, I think, the early 90s. But there's nothing currently of any sort. The only thing we have an exemption for is the sale of the shares of an active business. There are some differences with farmers and fishers. If you are in that category, then there is still the 1.2 million capital gain exemption applies there. as well. That helps.
That's
Right.
great.
Should be clicking these answered live. It's intriguing, this webinar thing.
It is, yeah. Oh, here we go. Sarah has one.
Because we have always done the meetings. Okay, so you're laying off and rehiring people every year because of being seasonal, then you still have to pay for people being staff for multiple years. I believe not, but I don't specialize in employment law, but the ones I've seen have always been full-time, long-term employees where you would have to pay their severance, because my assumption would be you're only liable for, uninterrupted employment. And this looks to me like it's been interrupted a number of times. So I would say no, that you would not have to do anything other than, if you sell the business in September, then whatever you do when you lay them off in September would be my advice.
Thanks, Sarah. Okay, I'll give a minute or two, see if anybody has any other questions.
Well, I was kind of curious whether people are like in the market right now to sell their businesses, or are you doing some forward planning, which would also be great. But anybody actively trying to move their business? Because one of the things I said, of course, is that in July of my business, I'm often quite willing to sell. And I suspect that seasonal workers, when you get to this time of the year, when the season's over, you're thinking, oh, I don't want to do that next year, maybe. But, well, let me change this. That's my last. I do have my contact information up on the screen. If you have questions you think of later that you want to ask me, that's my email address. I'm also quite active on YouTube with financial stuff and also some governance things. If you're looking,
that's great, Debbie.
Topics. I got very worked up about pricing back in September of 23 maybe. Anyway, recently, and I did a pricing video every day for all of September, which we set up as a separate playlist, because I've just had so much issue lately with, inflation and supply chain issues that people aren't changing their pricing often enough. And I thought that they should be.
Okay, I believe we have answered everything.
I got one more. No, oh, sorry, it's not a question, observation. Just started in 21, but you're in your late 50s. Well, so you only got 30 years left to work. That's quite a long time to be running a business.
There you go, Heidi. Only 30 more years, and then you can think about your succession planning.
You look at how long people are now. I have.
Exactly.
I have half a dozen clients who are in their 80s, their early 80s, mind you, who are still running their business and don't want to talk to me about succession. So yeah, I mean, we have longer than we had in the past.
That's right. Well, thanks so much, Debbie. This has been incredibly informative, and hopefully everybody is leaving with a lot of good information to take with them. So thank you once again for another great webinar. And I'm going to make note that when we do the next one with you, that it is done as a meeting and not set up as a webinar.
Yeah, I think that would be, well, for me, it's a little easier because
yes, and then you can see it, especially if we have a nice small group like this, then you can actually see and engage with people a little bit better than how we have done it.
Yeah, I mean, it's, well, who knew, right?
Exactly. I just see a couple of things pop up here as we are
saying thank you, which is always nice. So.
Yeah. So we will have it, as I mentioned, recorded so people can pop back and look over this great information as many times as they like to. And everybody enjoy the rest of your day. New Brunswick is getting snow. We are not. So we can be grateful or not grateful, depending on your viewpoint. And we will have Debbie back in the new year, I'm quite sure. So thanks again, everybody, and enjoy the rest of your day.
Thanks, Lynn. Appreciate the opportunity.
Thanks, Debbie.